This is our Forex blog for March 6, 2012. And like we do most days, we want to buy the strongest currencies versus the weak and sell the weakest versus the strong. If you have green histogram level at and above 80 level, this is made up of 5 different statistical trend tools that measure direction and intensity, averaged together into one very easy to read indicator. When you see extreme strength followed by very little weakness, and the daily, weekly, monthly trend is up, then it's up on all time frames, and you want to buy those versus ones that are down on all time frames. Euro, mostly the Australian. Underneath here we have the daily, weekly, monthly. The monthly is not quite as important as the daily and the weekly trend, and you can see the New Zealand weak on all time frames. However, it had a counter trend day to day up. So usually, if you have daily, weekly, monthly trend that's this strong down, after maybe 2 or 3 hours, you can usually expect the downtrend to continue. You never know how long it's going to continue here. In this case, you have about an hour down, hour and a half up, half hour down, hour up, and then you can see pretty much from 8 to 12, 4 hours of a downtrend. If you took every trade looking to sell the New Zealand, even though it was strong, you might have a few break-evens and small losses, but occasionally when you get that 4-hour trend, which most of the time happens. Notice the yen was up almost the whole day, so was the euro. You can see the Australian also was weak for 4 hours. When a longer time frame trend is down, most of the time you might have a few losses if you continue to look for sells in that pair, but usually it resumes the downtrend at some point. So let's look at some of the trades today in this. The strongest one is the dollar. We have the Australian is weak. The euro, especially here at 5 o'clock, is weak. Let's take a look at that. 5 o'clock, this one was very strong. So was the yen. Yen was extremely strong. In fact, right before 5, you can see much stronger yen than the dollar. So at 5 o'clock, you'd be looking to sell the euro yen. Let's take a look at this. In fact, the yen was so strong when it broke through the previous week's low. Just if you were watching this chart at the time, it's an amazing trade right there. Usually underneath the lower containment bands, I wait for a deeper pullback before I get short again. I might have waited for this one right here, and you can see that didn't generate that much of a profit. 55, the trailing stop got hit here. After the spread, you might not have even made anything. And then it pulled back up again, and you can see as you look at this bar, a lot of strength, and then it went back to weakness, even though it's going sideways. If you see a big downtrend and then you get a pullback, the bars turn red or pretty much white, which means no trend, and the daily and weekly trend is down. This is one of our entry methods right here. You get a pullback and then a nice little sideways rectangle pattern. You go short right here at right a pip underneath the low of that little area, 57, and notice our trailing stop got you all the way out here at 91. That's about a 67 pip win. It doesn't take a whole lot of trades like that. One nice trade like that gets rid of 5 or 6 or 7 losses. So take a shot when you see them. I would have shorted right here, and the trailing stop got you out here. When it's this far underneath the lower band, you got to wait for a little bit of a pullback. I would say at least 25 pips down here. You got a little double bottom. Notice on this pullback right here, almost no strength in comparison to the weakness. That's a very high probability pattern, but it doesn't always lead to the trend continuing right away. In this case, sellers weren't willing to aggressively go in there and sell yet without really first seeing how much farther up it's going to go. So when it went back up just barely a few pips above the previous swing high, that's a pretty big sign in and of itself when you have a weak trend like this. Notice as you visually draw this, just barely a higher high here than before. It's going sideways. Our statistical tools, as this is going sideways, other yen pairs are going down, other yen pairs are getting stronger, and that's what our tools show you without having to watch 12 other currency charts and trying to flip. Sometimes, the yen's always on the bottom and the euro's always on top, but with other pairs like the dollar CAD, the dollar is on the bottom of some pairs, on the top of other pairs, dollar yen, dollar Swiss, dollar CAD, euro, dollar, pound dollar, Australian dollar, New Zealand dollar. Sometimes it's on top, sometimes it's on the bottom. So while one's going up, it might mean the dollar's getting stronger, but if another currency is going down, it means the dollar's getting stronger. The human brain can't process all that information, but our computer can, and it can show you statistically both what percentage of euro pairs are going down and yen pairs are getting stronger, and the intensity of that. And that's what this tells you. When you see something like this, virtually almost the vast majority of euro pairs are going down, yen pairs are going up, and they're doing so with incredible intensity. If you see an up move, maybe 80 or 90% of euro pairs are going up and yen pairs are going down, but they're not doing so with intensity. We had, like I said, the Australian and the New Zealand go back and resume their longer term trends. And let's look at this versus both the dollar and the yen. Here is the Australian dollar. Now again, it's usually pretty risky to sell below the lower containment band. Coming up to 8, you can see it was going up. All the time frames are down. This is my Fibonacci profit target level that I thought would be support. You can see it was support here, support here, support here, and finally it broke down. When you find support and it doesn't make a nice bounce, I would say at least 35 to 50 pips, and you could even say most of the time my fib areas will retrace all the way back up to the hourly. There was no buyers there. It wasn't even able to come close to coming up to the hourly. And another rule of thumb is if the market is so weak it can't even retrace 38%, which would be right here. If it can't even retrace 38%, which I consider the minimum retracement for a possible reversal, it's very likely to go down. So while I wouldn't have necessarily sold right here, when it came up and did a little double top right here and wasn't even able to retrace the 38%, wasn't able to make it back to the hourly moving average, it's a pretty high probability place to short right here. And anytime it's underneath the lower containment band and it's broken through major Fibonacci profit target levels, don't get greedy, just draw your fibs on the last swing, and most of the time the first and second fib target is where you're going to get out. So you can see in this instance it came to 55. The Fibonacci profit target is at 52. There's also a 50-day moving average here. I would have just got out of the whole trade somewhere up around 60. Not the biggest trade in the world, but 25 pips. And I wouldn't have shorted it there even though it did continue down again. Let's take a look at the Australian yen. This one was also weak, and you can see it also broke through the Fibonacci profit targets I did last night. You draw your fibs on here. Again, notice it wasn't able to retrace back up to the 38%. That's a very big sign of weakness. And you might have even decided to sell right here. In this case, the pattern looks a little bit better. I would have sold right here. You can see it did not resume its trend. I might have lost 7 or 8 pips there, and then I shorted again right here. And if it goes sideways, I always exit half my trade. I tend to personally trade when it goes to a support area and goes sideways. I get out of half, and then I use the trailing stop on the other half. So I would have personally exited somewhere in the middle right here at 52, and the other half right here at 03. So obviously that second half made about 50 pips more than the first half. But even if you got out of the entire trade right here, let's just say at 50, you're short up here at 90, you made 40 pips. And if you got out of the whole thing when the trailing stop got hit, you made about 90 pips. The currency meter finds absolutely big moves. Let's look at the New Zealand dollar and New Zealand yen. Remember, at 8 o'clock, there was high probability that the New Zealand dollar is going to fall again. You go short right here. This one's a pretty high probability trade because it's not underneath the lower containment band, and it had not yet broken through the gray Fibonacci profit target. So you short this one right here. This is the kind of thing I would have traded a little bit more lots on, just because the odds are higher and the profit target's a decent number of pips away. It shorted 81.46. Our profit target's down here at 17, which is the middle of our fib targets. It's also the lower band. All the time frames are down. I would have just probably got out of the whole trade somewhere down here. Let's just round up to 20, and that would have been a 28 pip move. Let's look at the New Zealand yen to finish today's blog off. This one's nice because it pulled back yesterday, found a lot of support at the 20-day moving average and the monthly pivot, which is the average price of the previous month. Notice when it came down again, it went right to the fib targets and got a nice reversal. But again, it did not. Actually, this one did. It made a 38% retracement. It's always nice to sell it at a Fibonacci area. I probably would have sold it right here at 09, lost 7 or 8 pips, got short again. And anytime it's underneath the lower band, when it goes sideways, I tend to get out. So I would have got out probably somewhere around 79. I wouldn't have expected this other huge move down. But even that trade right here at 10, I'll just say I got out at 80. That's 30 pips. If I lost even as much as 12 on the previous trade, you lose 12, you make 30, you net 18. 2 trades, that averages out to 9 pips profit per trade. That's the way you got to look at trading. You're going to have sometimes, a break even, a loss, a medium-sized loss. You might even have another loss. One nice 30 or 40 pip move gets back all your losses and leaves you usually at the very minimum, with my own experience, with at least 10 pips left over. And 10 pips a day doubles your account every 2 months using a very low 2% risk per trade.